Good evening, ladies and gentlemen. Welcome to Corporate Connect webinar supported by SGX. We will start today's program with our first speaker, Mr. Benjamin Goh, Head of Research SIAS and Senior Lecturer, Singapore Institute of Technology. He will be sharing with us on tales from the US stock market. Mr. Goh, please.
Thank you very much, Christine. So evening, ladies and gentlemen. Thank you for joining us this evening. We're going to have two sessions. My part is going to take no more than about 20 minutes. I'm going to talk a little bit about what's happening in the US market given the stock market volatility. And the second part will be a presentation from NetLink NBN. All right, so I'll try to keep my part small so that we can get ahead to the main event as soon as possible. Okay. Let me just see. Okay, my slides are working. All right, tales from the US stock market. All right, just a couple of slides. So what I want to do is kind of quickly run through what's been happening in the last few months and what might be happening next. So as you can see, or if you already know, the last recession in the US stock market was in the year 2009, 2008. That was really because of the blow up in the real estate sector in the US. So the scandals as well as the recovery related to the great financial crisis. So as you can see, a business cycle normally is about maybe, I don't know, 12 to 14 years. So it's been quite a bit of time since the US has had a recession. So even before COVID-19 pandemic came onto the radar, most of us were already wondering when the US was going to hit into a recession, because that's kind of the normal behavior of a business cycle, right? So we can't be in a bull run all the time. There usually needs a period of time when the economy starts to slow down a little bit of a bit of a fatigue and to pause and catch his breath. And we were already wondering when that was happening. So this COVID-19 pandemic has kind of hit the brakes for everybody. So yes, we were expecting a recession, but not really from this this reason. But nevertheless, the US has already headed into a recession that was already officially and formally marked by a bunch of eminent economists in the US. Now, prior to the stock market correction in Q1 this year, as you can see, the US stock market has generally been in a very strong bull run for the last 10, 11 years. There have been a couple of scares, corrections, so on and so forth, but not really because of anything fundamental to the US economy. Now, as you can see, since the middle to the end of late February until late March, what has been happening is that the US market has corrected quite a fair bit. Now, if you are, kind of aware of a little bit familiar with the technical analysis, you can see that the RSI, the relative strength index for the US S&P 500, have generally been quite strong, hovering in the overbought category region for quite a fair bit of time. And obviously, at the tail end of first quarter 2020, it collapsed into the oversold section of the RSI. That is obviously quite predictable given what's been happening in the stock market with, as you can see, prices plummeting down below all the moving averages. And of course, since then, we've got a lot of news flow. A lot of pharmaceutical companies are coming online to obviously build up the supplies of healthcare infrastructure, as well as tools and equipment for the healthcare workers. But also on the longer term, we do also have a couple of companies working frantically on a vaccine for the COVID-19. All right, so the ETA, the expected time of arrival for all these new medicines at least a year out, but of course, the timeline could change. Now, as coming back to the stock market, as you can see, it has recovered quite strongly, actually unbelievably strong since the end of March. And of course, the next question is what may happen next. Okay. Now, as you can see in recent mass media reports, a second wave in the US of COVID-19 is definitely coming online. So as major states reopen their businesses, the economy, you also have got, things like crazy undergrads celebrating the summer by all going to the beach together and therefore, all getting sick together, and that really is a thing. It is happening. So the second wave of the COVID-19 infection is already upon us. All right. So it's not a question of whether it's going to happen. It is already happening. So what is going to happen in the US? That's a question that we want to kind of answer right now. Now, if you've been following the news, the US Congress, as well as the Federal Reserve Bank of the US, that's basically the central bank, has been putting out a lot of measures, right? Giving people, in a sense, helicopter money, support, social support, monetary support, not just for individuals as well as businesses, really. And all these have kind of moved the US economy away from a worst case scenario. All right. So in the beginning, when the pandemic first started, we were all wondering where is the bottom. But it appears that because of all the measures that the government as well as the Fed has put in, we are probably not going to be looking at a worst case scenario. The next question is, of course, traditionally central banks like the US Fed, they tend to have a certain selection of monetary tools. For example, they can change the interest rate, they can do something in the swap market, they can lower the cost of funding for businesses, so on and so forth. All these are the tools which are generally available to a central bank to try and move the economy away from a major recession. And in the US, all these tools have already been put into effect. As you can see, the US Fed chair, Jerome Powell, has already moved towards a zero interest rate policy. So if you're looking at the interest rates of US government bonds, we're talking about the yield curve here, if in the short term has already collapsed to close to zero. Okay. The question is, what is next? So it is our opinion. Oh, and I forgot to mention, whatever we speak about today, right, is obviously not a recommendation, because SIAS, we are not in the business of making recommendations. So you should see a licensed finance professional in order to optimize your portfolio. So don't take our word for it. So we're not licensed. So it's just an opinion. So it's our opinion that the US as well as the central bank still retains a significant firepower to fight the COVID-19 pandemic if required. So this could show up in the way of negative interest rates. Yes, still controversial. Yes, that's a thing now, but at least people are talking about it and debating about it. And it's actually not something new. Other major economies have already done that before, but the US has not. So that could be a game changer. As well as actually directly intervening in the US stock market to buy up stocks. Again, the US government is usually not in the business of doing that. But if you take the example of the Japanese government, they've been doing that for actually quite a few years, basically to support the US basically just to support the stock market to make sure that people don't go into panic mode. So these are kind of the extreme and exotic measures which the US Fed as well as government can still opt to do if the COVID-19 pandemic drags on. Now, for the market as a whole, we are already starting to focus on the earnings for second half 2020 as well as 2021. First half 2020 is kind of a, it's gone, right? So it's a burnt first half. It's kind of gone. Companies' bottom line have already been decimated, so on and so forth. So now the market is looking forward to, the second half as well as next year. Now, there are a couple of scenarios that have been kind of gamed out by Bloomberg. All right, and you can see it here. So the first scenario is that there is going to be a somewhat pretty good recovery in the second half of 2020. And the second scenario is that the recovery is not so strong and the US heads into an extended recession. And of course, the third scenario is basically the consensus, kind of a blended scenario, right? So what we can do is kind of look at all of these things in turn. I'll talk through some of these things. Now, if you look at the blue bar, the blue bar is basically the earnings per share growth, all right, for 2020, and the white bar is the earnings per share growth for 2021. So let's look at the most optimistic scenario, which is the first one, second half 2020 strong recovery. Even in light of a fairly strong recovery in the second half of this year, we are still going to have an overall downturn for full year earnings per share for this year, right? But that is kind of in the region of between negative 10% to negative 15%. All right, so bad, but not abysmal. So it's not the end of the world. And of course, the flip side is that usually what happens in banking or in finance is that if you have got a terrible year in one year, the next time period normally is going to have pretty good catch up, right? So in 2021, Bloomberg does expect earnings per share growth to recover to between 20 to 25%, which is fairly strong. Now, what happens if, let's say, there is an extended recession in the US? For the second half of this year, we might be seeing a negative earnings per share growth of up to 25%. That means a reduction of 25%, which is fairly significant. But again, even in this kind of scenario, we might be looking forward to a plus 20 to 25% recovery next year. Again, as you can see, if you take the 2 years together, it kind of offsets each other. But of course, it'll be good to not have an extended recession in the US, all right? But I just want to put it out there that even in the event of an extended recession, these are kind of the numbers which analysts are looking at. So it is bad, but it is not the end of the world. And of course, the last one is kind of the consensus, right? So a negative 15% EPS growth for 2020, but a fairly strong EPS growth of slightly more than 20%. Again, if you take the 2 years together, it kind of evens out. All right. So I guess the kind of message here is that for 2020, it's pretty much a loss year. All right, but then in 2021, we do expect the US earnings per share to kind of catch up and even out. So which means that across 2 years is going to be flat, more or less flat for EPS. But of course, the flip side is that it's only 2 years, not 5, 10, or 25 years. All right, so there's always a silver lining somewhere. Next, of course, we want to look at relative valuation. So by looking at the PE ratio, it tends to give us an idea of whether or not the stock market is relatively cheap or relatively expensive compared to historical precedent. Now, we're going to do something a little bit different because we already know that next year's earnings per share, or rather second half of this year as well as next year's earnings per share, is probably not going to be representative of the long-term historical average. So what we have done is basically to look at the 1 year estimated earnings per share as well as the 2 years estimated earnings per share. That means the second year out. And what we've done is to take these 2 years, sum it together, and divide by 2. Essentially, we have used the average 2-year estimated earnings per share as the denominator. All right, so that and the reason why you want to do that is basically to even out the huge swing in the earnings per share for the next 2 years. And by using that and taking the price of the S&P 500 and divided by this 2 years average, we have plotted this chart. So this is essentially a kind of a PE ratio calculated on the back of 2 years average estimated earnings per share. And you see, as you can see, right, the numbers for 2021, 2022, as well as the rest of this year, it is not abnormally high, at least compared to what happened in the great financial crisis, as well as the dot-com crash. Right, so if you go all the way back to long time ago, the year 2000, 2001, during the dot-com craze as well as subsequent crash, the PE ratios for the S&P 500 was really high, hitting about 15-ish, north of 15. So even if the kind of the very bad scenario kind of transpires in the US economy, we are probably not going to be seeing those extremely high numbers going forward. Okay, so which means that the market is going to be relatively fairly priced. Okay, Now, a couple of lessons from what we learned in the Great Financial Crisis. One of the reasons why the US stock market has been doing so well since the year 2009 is simply because of monetary policy, right? So the Fed chair at that point of time, Mr. Ben Bernanke, also instituted a policy of zero interest rates. And how it works is that if the bank is willing to lend you money at zero interest rates, then the cost of funding is essentially zero. So that is probably going to be an incentive to start a business, employ people, or to take their money and deploy in capital markets. And that's really what some of the major banks in the US have done. So they basically took money from the US Reserve Bank at zero interest rates, and they went and traded it on the capital markets. That's one of the reasons why a lot of the risky assets, such as stocks, commodities, so on and so forth, kind of recovered very quickly in the last 10 years, and essentially has been improving year on year. The US stock market has been kind of in a bull run for the last 10 years. And that's really because of what Mr. Ben Bernanke has done. So we need to thank him later. For some of us who became millionaires in the last 10 years, we need to thank Mr. Ben Bernanke. Okay. Now, jokes aside, as you can see, the zero interest rate policy was pretty successful in stabilizing the US stock market. After only a mere 3 months, it kind of stabilized. It wasn't going down anymore and went into recovery phase. But otherwise, what is more interesting is that the Russell 2000, and for those of our friends here who are not familiar with the Russell 2000, this is basically an index that tracks the mid-tier companies in the US. So there are 2,000 of this, not the big caps, but the middle caps companies in the US. So these will be the companies which generally sell domestically, so they may not have a huge presence overseas. They are not like Microsoft. They don't export overseas. Their domestic market back in the US is really their market. And what has happened, given historical precedent, is that over the course of 5.5 years since the Great Financial Crisis, because of what Mr. Ben Bernanke did, the Russell 2000 basically outperformed the S&P 500 by about 45%. All right, so we know that in 10 years, S&P 500 went up like this. The Russell 2000 went up like this, okay? So, very liberal monetary policy tends to benefit the middle cap, the mid caps, more than the big caps. All right, so back to the future. On March 16 this year, 2020, the Fed, under the governorship of Jerome Powell, basically again introduced zero interest rates in response to the COVID-19 pandemic. And if you are tracking the Russell 2000, it is already outperforming the S&P 500. All right, so in the last 2-3 months, S&P 500 came back very strongly, but the Russell 2000 did even better. Okay. Now, what can we expect going forward? Now, a lot of the recovery in S&P 500 was essentially driven by high volatility stocks. All right, so give you an example. You've got a FANG stocks, right? The Facebook, Apple, Netflix, Google, so on and so forth. Yes, there have been a lot of volatility, but essentially the market has been driven higher by all these companies. So these are the high volatility, high beta kind of stocks. And really, there are already signs that the rotation into all these high volatility stocks are overdone. As in, the market is getting tired of this kind of stocks, and these stocks the prices have gone up fairly high, fairly quickly, and we do expect the market to start rotating into the lower volatility stocks. All right, so these are the ones which are going to be a little bit more low beta. All right, so that could be something that we're going to be seeing going forward. Now, as usual, whenever there's a rotation of leadership in the stock market from one sector to a different sector, we might be seeing a period of consolidation in the S&P 500. All right, so for the next few months, summer months, we might be seeing a period of a lack of direction in the US stock market. So as you can see, the US stock market for the last week or so already have been quite volatile, can't seem to be making up its mind. But as you can see, it is, and if I can just flip back to the chart here, it bounced off very strongly from the 200-day moving average. So that's kind of a pretty strong support line there. All right, so this chart was, I think, good as of last Friday, I think. Okay, so as you can see, we might be heading into a period of a lack of direction simply because of the rotation of into the less volatile stocks. All right. So, but the big picture is again coming back to the big theme is that I think we have dodged the bullet. All right. So the zombie apocalypse is not going to come, right? So maybe unfortunate for some of us, but it's not going to be the end of the world. It's going to be slow and steady going forward, even though the second wave is of COVID-19 infections is coming on. All right. So that's a kind of a hopeful message I want to leave you with. All right. So that's it from me. Exactly 20 minutes. Christine.
So thank you for sharing, Mr. Goh. That was very helpful. So next up, we're pleased to have with us today Mr. Tong Yu Heng, Chief Executive Officer, and Mr. Lester Wong, Chief Financial Officer of NetLink NBN Trust. Mr. Tong?
Hey, hi. Thank you, Christine.
Okay.
Thank you. We will share slide. Okay. We can go to slideshow mode. Okay. Good evening, everyone out there. Thank you very much for spending your time with us. I'm Tong Yu Heng, the CEO of NetLink NBN Trust. With me is my CFO, Lester Wong. Two of us will take about 15 minutes to give you a presentation on NetLink NBN Trust. Thereafter, we will be happy to take any questions that you may have. Okay, moving on to the presentation, slide 3. We announced our result, the full year result for the year ended 31st March 2020 on 6th of May. So what you see here are some of the key numbers from our full year result. Revenue, 370 million. Against last year, the year FY19 is up 4.7%. EBITDA, or the operating cash flow, is 258 million. And against the corresponding period last year is 4.3% up. We have a fairly healthy cash balance, 169, of which I'm happy to say we have distributed about 96 million just in June back to our unit holders. Gross debt is 666 million. Market cap above 3.5 million now, 3.5 billion now. Moving on to the next slide. Okay, we have been asked a number of times, how long our fiber asset will last. Because I think for those of you that are familiar with us, you know that we are basically a fiber operator in Singapore. We provide all the fibers to the home. And if you are using broadband, then basically you are using our fibers. You may be using a M1 broadband, StarHub broadband, or Singtel broadband, but you'll be using our fiber for their broadband services. So our key asset is basically the fiber asset. So we have been asked a lot of time, how long is the useful life of the asset, and whether or not we have competition. So this slide is basically to address some of these questions. Fiber is a medium of choice for the broadband services today. Today, every one of us, almost every one of us, would use two different type of broadband services. One is mobile broadband. When we are up and about with our mobile phone, we'll be using mobile broadband. When we are at home, we'll be using our fixed fiber broadband connected to a router, and then we have Wi-Fi at home. About 94% of all homes are using our fiber broadband today in Singapore. Fiber broadband prices are also lower in Singapore than in many other countries. This is important. This means that the remaining 6% household that are not using our fiber broadband, there's a good chance that they will sign up because the prices are actually not very high. The other thing is the take-up rate, today is 94% penetration in Singapore. What we hope is, of course, it will cross 100%, meaning some household may even take up a second fiber because the broadband prices are low in Singapore relative to the broadband prices in other countries. Fiber is not only used to support fiber to the home to provide a broadband service, but fiber is also used to provide connectivity to outdoor sensors, mobile base station, and we think this application for sensors and other outdoor infrastructure the demand for such application will increase, and therefore we see that there will be more requirement for fiber to go and connect all these what we call street furnitures, the lamp posts, the street lights, the lamp posts, the traffic lights, and the bus stop. Fiber capacity is also highly scalable. We are the owner and operator of the fiber network. We provide this fiber to the telecoms customers that we have, like Singtel M1, and they will put the electronics at both ends of the fiber for data transmission purposes. So if they change the equipment, the fiber is able to carry a higher bandwidth and a higher data transmission rate. Today, most homes are served by a fiber broadband of up to 1 gigabits per second. That can be upgraded. As long as we change the equipment, that can be upgraded to carry 10 gigabits per second. Next slide. Okay, this slide is an interesting slide because it basically explains what we do. Starting from the left, we have a NetLink central office. We operate from 10 of these central offices across the island in Singapore. So with 10 central offices, we can cover the entire Singapore. From each of these central offices, we will have underground ducts to all the buildings around it. And within those ducts will be fibers going into the buildings. So today, we have fibers into 1.42 million residential homes in Singapore and about 47,000 non-residential end users in Singapore. We also have fibers to outdoor location. These are embed. We call it embed location. Embed meaning non-building address point. Any location that does not have an address, we call this embed, non-building address point. We have 1,679 connections. These numbers are important to us because each of these end users, from each of these end users, we will get our money recurring revenue. We do not get from the end user directly. These end users, if they subscribe to they will be subscribing to a service from one of the telcos. The telcos will collect a money fee from them, and then the telco will pay NetLink. So, for example, the 1.42 million end users, they are subscribing broadband from one of the telcos in Singapore. They may pay $40 a month or $50 a month. We collect from each telco for each one of these 1.427 million end user, $13.80 per month. For the non-residential customers, the 47,000 here, we collect $55 a month. And for the outdoor embed customers, we collect about $73.80 per month. Over to the next page. Here, we will explain our revenue model. We have a very resilient revenue model. Why do I say so? I already mentioned that we have 1.42 million residential connection. From those connections, we receive about 62.5% of our FY20 revenue. And the non-residential, 8.4% of our revenue. Embed and other type of fiber connections that we provide to telcos, 2%. So in total, this is about 73% of the total revenue, all from connections to end users. So the risk to our revenue is very low because once connected, all these end users will want to stay connected. And we only expect these connection numbers to increase over time. So these are very low revenue risks there. Next, we have the 8.2% ducts and manhole services. This is basically use of our duct space, which we lease to Singtel. So Singtel basically pay rent to use the duct space that we of our underground pipes or underground ducts. Next, we have installation-related revenue and diversion revenue. These are activity-based revenue. Installation revenue, I just give you a quick example. It could be installation in the home. We put a fiber termination box in a new home and we will charge the end user. Or we carry out installation work for our telcos that want a fiber to connect to a lamp post, for example. Diversion revenue will be revenue that we obtain largely from government agencies that require construction work done. When, for example, if the LTA would like to construct a train station, they will require us to move cable from underneath, away from the train station so that they can carry out construction work. So these are diversion revenue. On the right-hand side, you have co-location revenue and central office revenue. Co-location revenue and central office revenue are basically revenue that we derive from the leasing of space in our central office. We operate from 10 of these central office. So the leasing of space to the telcos We will get rent from the telcos. So this is, and generally these are for long term, on the long term basis. This leasing arrangement is on the long term basis. So if you look at our revenue model, a large part of it is from connections, 73% I've mentioned. Some of these, and 8.2% from leasing to Singtel, leasing the ducts to Singtel. Another 5.5, 4.8%. These are leasing of space in our central office. So the revenue model is a very, very stable one. And for those that are activity driven, installation and diversion, yes, it depends on whether or not we have orders to do installation work or diversion work. But in Singapore, as you know, there are construction all the time, except for this COVID period, if I may say so. But there are construction all the time. So there are activities in these two revenue streams, which give us a fairly recurring sort of revenue from these two kind of work that we do, diversion as well as installation. Moving on to the next page. Okay, here's a quick look at our numbers over the years. Residential, I have already mentioned that we have reached 1.427 million end users. So you can see the trend has been fairly positive over the years. And non-residential, we have reached 47.7. And NBET, we have reached 1,679. We also have another 415 segment connection. These are connections that we provide the telco to connect point A to point B. Now I'll hand over to Lester, my CFO, who will take you through our full year result as well as the fourth quarter result. Lester, please.
Thank you, Yu Heng, and good evening to all. Yes, thank you. So our financial year ends on the 31st of March. So early last month, we reported on the fourth quarter as well as the full year. In slide 8 here, you'd see the financial performance of our fourth quarter. In this quarter, our revenue grew by 5.2%, and this is mainly due to the higher number of residential connections. There was a growth of about 100,000 new residential connections from a year ago on the back of StarHub customers that migrated from StarHub's cable network to NetLink's fiber. The revenue was also, the variance of the revenue was also influenced by some of the activity-based revenues that Yu Heng spoke about earlier, which can fluctuate from period to period. So diversion revenue was higher, but this was offset by lower installation-related revenue. Okay. Now the focus on NetLink's financial performance should be on its EBITDA, which is earnings before interest and tax, depreciation, amortization, and not on profits before tax, because EBITDA gives you the best proxy for the cash flow that NetLink can generate from its operations in order to make its distributions. Depreciation and amortization is non-cash, and the depreciation and amortization expense is high because we have a $3 billion asset base. Okay, in this quarter, EBITDA dropped 11%, but this was mainly just due to a one-time write-off of $15.4 million of capitalized project costs from a terminated IT replacement, system replacement project. Okay, and we made an announcement of this termination of the contract on the 27th of February, so there will be more information around this in that announcement. But the write-off did affect our Q4 results. Excluding this write-off, however, EBITDA grew by 13.3%, as you can see at the bottom of the table, and we achieved our a normalized EBITDA margin of 77%. Now, we have consistently achieved EBITDA margins that are around 70% or higher since the IPO. Okay, now with that, I'll move on to the next slide, please. This shows you the FY20 financial performance. Again, revenue grew by 4.7%, largely for the same reasons that I mentioned earlier for Q4. But you can see that the EBITDA had increased by 4.3% in spite of that one-time write-off of 15.4 million. Excluding that one-time write-off, EBITDA grew by 10.5% and achieved an EBITDA margin of 74%. Okay, I think also just to explain that NetLink's cost structure is mainly comprises of fixed and semi-fixed cost components. Excluding depreciation and amortization and finance charges, staff costs, property tax, system maintenance costs would account for 50% of the rest of the costs and expenses. Operating and maintenance costs, installation, diversion costs accounted for about close to 40%. And hence we have a very high degree of operating leverage, which actually supports the point that Yu-Hing was making about a very resilient business model, not just a revenue model. Okay, also just to mention, in Q4 as well, we also booked higher other income that comes from the government relief measures, such as the job support scheme, as well as the property tax rebates. Okay, and with that, I move on to the next slide, which shows you some key balance sheet figures, okay, which I just want to highlight. Actually, if you look at the leverage ratio, which is the gross debt to EBITDA, and as well as the EBITDA interest cover, these multiples that you see down here actually suggest that we have a very conservative capital structure with a lot of debt headroom to be able to fund future capex. Okay, and we do not have any debt that we need to refinance up until March of 2021 next year, when we have a term loan facility of about 510 million out of that 666 that needs to be refinanced. And we're very confident that we have no issue refinancing that. And we're exploring various options now to refinance that debt. Okay. With that, I move on to the next slide. Okay, this slide here just shows you the NetLink NBN yield that was achieved if you based on the unit price of 90.5 cents, which was the closing price on as the 31st of March. And our 5.6% yield is even higher than that of the STI yield, as well as the FTSE ST REIT yield for the same period. We grew this distribution by 3.5% from financial year 19. Okay, and we expect that with a resilient business model, we should be able to continue to distribute very sustainable and predictable distributions going forward. Okay, with that, I will hand it back to Yu-Hing to talk about our focus for FY 2021.
Thank you, Lester. Our focus for this financial year, FY21. Obviously, residential is very important to us. We will continue our efforts to connect household not on the fiber. We have various initiatives. We are working especially hard to reach low-income segment and the household that are not using our fiber broadband yet. We will continue to invest and to roll out our fibers to new housing estates to connect new homes. Another thing that we are spending quite a lot of time on is to improve our service provisioning quality of service. Our service provisioning quality of service is how quick we could turn around and how quick we could connect our customers. That has improved over the years significantly, and we'll continue to focus on it. On the right-hand side of this page, you will see some other initiatives in the non-residential segment, in our fiber, and also the point-to-point fiber segment. What we are doing is to densify our network. We are adding capacity, flexibility, and resilience in our network. Our network has been designed very well to serve fiber to the home, and most homes in Singapore today are connected. The next phase, as we see it, is to connect all the outdoor street furnitures as well, as and when required. So we are making our network more flexible and ready to serve this sensor deployment and other deployment of other devices across the island, as and when they happen. We are also making the network more ready to support any 5G deployment. And separately, we are also targeting SMEs, the small and medium enterprises in Singapore. A lot of them in Singapore are not using any kind of fixed broadband services. When I say fixed broadband services, I'm referring to fiber-based broadband services. They could be using mobile broadband or none at all. Some of these are very small businesses, but we would like to target them to help them get connected. We are also improving our presence in major data centers. As many of you will know, Singapore is a hub for data centers. There are many data centers in Singapore. We are already connected to all the data centers, but what we want to do here is to make more of the tenants use our fibers and use more of our fibers in the data centers. As I mentioned, we want to make the deployment of any outdoor sensor easier and faster. So we are bringing our fiber closer to some of these street infrastructure. With that, I've come to the end of our presentation. Lester and I will be happy to take any question.
Thank you, Mr. Tong and Mr. Wong. So before we go on, in our last segment, we will have the Q&A session. We will start the Q&A session with the pre-submitted pigeonhole questions and followed by addressing the questions that are posted on Facebook. Also, due to time constraints, we would like to seek an understanding that not all questions will be addressed. So without further ado, we would like to invite Mr. Richard Dyerson, General Manager, Planning, Education and Research, SIAS. And as well as
Thank you, Christine. Good evening, Yuheng, Lester. Thank you for joining us today. I know we live in really extraordinary times, and thank you very much for doing this. I think you guys have been very supportive of SIAS and our initiatives and reaching out there. As you can see from your share price, you actually recovered from the March disaster, and it goes to show that a lot of investors are actually looking at asset-backed securities, and this is an example of what we call asset-backed securities. That you have the assets are the fibers that they are getting the dividends from, and I think besides this, because of the technology that it provides, connecting a lot of the workers during this time, all working from home, using your network. And actually connecting them, and this is the way of life that's going to be as we see, together with yourselves and other counters that actually dealing mainly, as you talked about, data centers, had actually performed very well during this time, especially and this period especially has affected a lot of the other asset-backed stocks that were really in the retail and the REIT space. But let's start off with some of the questions they have. And when the first question I think we were talking about is that you talk about 5G, and I think a lot of people are asking in terms of explaining in terms of the rollout of 5G. What is expected in relation to how would it benefit NetLink?
Richard, thank you. Thank you also to SIAS for inviting us. We're happy to be here. Thank you for the question as well. We have been asked a lot about 5G. 5G development and also the development of any initiative or smart nation or any development that require fiber connections will be positive for NetLink, because at the end of the day, we are a fiber infrastructure provider. But I have to say and perhaps make clear also that we are not a mobile operator ourselves. We just provide fibers. We discuss with the mobile operators. We would like them to use as much of our fibers as possible. And today, before we talk about 5G, actually today, we are supporting TPG because they have rolled out fiber, a mobile network. We have provided fiber to them for their mobile network. And actually, we are also supporting two other mobile operators. We have provided some fiber to them, but not a lot, not as much as TPG. The reason is very clear, because they have their mobile network up and running before we even started putting out fiber. So they already have a lot of infrastructure in place. But now and then when they have a particular location, they feel they need a fiber connection, they will come to us and say, hey, look, why don't you connect a fiber for us? We will pay you for it, but please provide us a fiber to a new mobile base station location. So we work with a lot of the mobile operators. And back to 5G now. So we are positive about it. We think that will generate more demand for base station requirement and all that. However, I have to add that it depends on how quick is the pace of a rollout. Our number of connections will be linked to the pace of the rollout, how many connections we can get and all that. And I would not want to raise the wrong kind of expectation that people think this is going to be we are going to make a lot more revenue from this 5G connection. It's not going to happen that way. I hope so, but it's not going to happen this year or even next year. We will get more connections and a little bit more revenue from those connections, but not a lot more. Because we have to bear in mind that we get a lot of our connection revenue from residential, the 1.427 million. It's in terms of millions of connections. 5G will not reach the kind of number of connections. 5G, although each connection we will charge more for each of these dedicated point-to-point connections, but there will not be so many connections. But generally, we are happy with the 5G development. We are watching it closely. We will be there to support the mobile operators.
Actually, you hit it on the nail. Now SIAS is today a charity, and I actually work with some of the other charities. And recently, because we actually conduct also quite a fair bit of the governance training for all the other charities. And there was one particular charity that actually came out with a very brilliant idea. They were looking at how to monitor the elderly. When you have elderly living alone, how do you monitor? So they created a fantastic device. And they said, okay, if we detect that this particular device is not moving for some time, we will alert the people, and then someone will go there to actually go and check it out. But they found they couldn't deploy this device because all these homes with elderly people don't have any broadband or even fiber or any Wi-Fi, which all these devices require to feedback. And I think I very applaud you in terms of looking at moving forward, especially in a lot of the elderly homes who are not yet even connected today. And actually working with the charities is one of the ways to actually reach out to these connections. That's just an observation.
No, actually, I will comment on that. We just released our annual report on Monday, yesterday. And you will see that we mentioned that actually one of our corporate social responsibility initiative is to support a scheme administered by IMDA. We are committed to support them to the tune of $600,000, $200,000 per year. And this $200,000 per year is to support the low income, and that includes the elderly, to homes that do not have a fiber connection today. So they can apply to the IMDA, through the IMDA, to get free PC or subsidized connections and so forth. So the whole idea is to support this group of people to get all of them connected. Because I don't think we want a digital divide between those that have the broadband and those that do not have the broadband. I think in Singapore, what we want to do is to make sure that everyone is connected.
Yes.
Right? Some of us may be heavy users, some of us are not so heavy user, but we still want you to be connected to the fiber broadband.
I think, unfortunately, Wi-Fi is no longer a need. It's no longer just a want. It's actually a need, and you really need it. And we're just talking about just basic healthcare and tracking today. That's the. I think there was another question that has been submitted asking about some explanation regarding the 1.4 million project write-off in the last quarter. Perhaps Lester, I think perhaps you can explain a little bit more about this.
Sure. Actually, the figure was a 15.4 million.
No, sorry, 15.4, correct.
Yeah, 15.4, of which actually about 6 million or so is in relation to staff costs. That means, our own staff that were involved in the project that was capitalized in the project. So 6 out of the 15 was just internal costs, but it had to be written off anyway. The rest of it was for, mainly, the project work, the software that we couldn't take over. Now, I think this was a mutual discharge by both sides, for the system vendor and ourselves. We came to that agreement only in February after quite a prolonged, I think, a discussion and negotiation and dispute over why the project could not actually move forward. So I think on the basis that we just didn't want to get into a very prolonged dispute type of arbitration or litigation, I think on that basis when we decided that we should just walk away essentially from that project. But it's behind us now. We will maybe consider exploring other types of systems because we do need to eventually replace our systems also.
So going back to, I think this person is talking about dividend payout, and this person said, I quote him, I read that NetLink Trust free cash flow is not able to support the dividend payout, and has to use borrowings. Given the situation, will there be reduction in dividends in the future? I think we'll just clarify in terms of what is the dividend policy as well.
Maybe I'll jump in here and Lester can add on. Actually, it's correct. If we look at the accounting free cash flow, free cash flow is EBITDA minus capex, and then you have the free cash flow. So we distributed more than the free cash flows. But let me start from EBITDA, which is our operating cash flows. We generated for FY20 EBITDA of 274 million. And we have to pay interest of about 20 million. So 274 minus 20 will be 254. We distributed 196 million for the whole year. So 254 minus 196, we have a balance of 58 million. So we have enough cash flow to meet the distribution requirement. So we have a balance of 58 million. We didn't distribute all. We have a balance of 58. This 58, we apply it towards a capex. So our capex was 75 million. So there was a shortfall. So we borrowed another 20 million or so for the capex. So we borrowed 20 million for capex. We used $58 million for capex. I think the person who asked the question is, okay, you take 274 minus your distribution 196, no, minus your capex was 75, then you don't have 196. That's correct. I think that is correct. And that's a very good observation. And we are well aware of this. But our cash flow is definitely more than is required for distribution. But the fact remains that after distribution, we have 58 million for capex, but it's not enough for the full amount of capex. That we are aware. In fact, we have said that at IPO in 2017. We have been very transparent. We say, look, going forward, we will fund our capex partly by cash flow, partly by debt. And therefore, we have deliberately started out in 2017 with a balance sheet that is very lowly geared. So that allows us to continue to borrow. And we expect our EBITDA to continue to increase and grow also. So and I think I will answer another question that I think will come once I stop here, is that, okay, can you continue to borrow and for how long? Because you are borrowing to fund your capex. I think for a very long time, we are very confident. If you look at the amount of cash flows that we can generate and the borrowing level that we have today, it's actually a very low for infrastructure of this risk profile. We have very low risk profile. So we can afford to do that. Actually, look at it another way. There are a lot of listed entities that whenever they have a capex, either they borrow or they will come back to the shareholders to raise the money to buy the next building. or another. We're not coming back to the shareholders to ask for money to buy the next project. Right? We have no plans to do that because we are quite comfortable of our cash flow generating ability. I think I'll stop here. Lester, you want to add anything?
Just want to add that actually, if you look at the time of the IPO, we had a gross debt to EBITDA multiple about 2.3 times. 2.5 years later, we're looking at 2.6 times. So it really has not grown. This multiple hasn't grown very much because we have been generating very good cash flows and EBITDA has actually outperformed. So I think, instead of looking at just free cash flow as the way to finance, your distribution, I will look at actually, the other way around, which is using your debt. Essentially, the cost of capital or the cost of debt is actually lower, and we do not want a lazy balance sheet, right? So it actually makes sense to finance part of your capex with debt as well.
So, we talked about, we talked about threats, and recently, I think SP Telecom also announced that they are also going to establish a whole new fiber network, therefore creating competition. What's your view about this, and where do you see this going? And in terms of more competition in this space?
Actually, thank you for the question. SP Telecom is not, we don't see them as a competitor. In fact, we see them as a customer. And in fact, because of their desire to expand their reach to target enterprise customers, so they're strengthening their position there. And because of that, actually, they come to us and order more circuits to help them with, to build out their network. Because we have a network that is island-wide, you know, and we can cover all locations. So any other telcos that want to roll out and build their network, they could certainly have their own fibers in some locations. But if they want a very comprehensive coverage, they will have to come to us for some of the circuits and all that. So for SP Telecoms, indeed they have become our customer. Another area is that they are actually focusing on the larger enterprises so that they can provide them end-to-end connection as well as enterprise solution. This is not a segment that we are involved in. We are just involving in providing fibers to the non-residential space and then fiber to the residential space. Yeah.
Let's hope they keep building more homes. The construction workers have to go back to work first.
I think it's unfortunate. I think we all found ourselves in this COVID-19 situation, and the level of activity have slowed down over the last 2 months or so. I think the level of activities will pick up. I would say this level of activity slowed down because we don't have enough foreign workers, construction workers available. Has also affected us, I guess, in the last 2 months, in the sense that our activity that is based on construction work, you know, I just mentioned two just now, installation work or diversion work, we can't do that for 2 months. But that doesn't really affect us a lot, because the bulk of our revenue is still from connections. And you talk about new homes. I think Singapore plan is to continue to build new homes. And then one only need to look at the Singapore master plan for the next 50 years. You will have a sense of where are all the new homes coming up. One big area that we are all working on, in fact, as I speak, you know, we are still rolling out to that area is Tengah. You know, Tengah is going to be built for the next 20 years. You know, that's a very huge area. Of course, beside that, you have Punggol. You have other area like Bidadari and many more. So Singapore continue to build. I can look at the historical number. Historically, Singapore add about 25,000 homes a year over the last 10 years, on average about there. So my expectation is that we will see this kind of number going forward also.
I think going back to another finance question from this person, the NetLink P is about 49. How is this justified at a high valuation? And what is the expected CAGR? I think Lester, perhaps you take this.
I think you know, that's in my presentation earlier on. I think I made the point that the focus should be on EBITDA, because EBITDA is the best proxy for how much cash we can generate for distributions, and not to look at the earnings, because the depreciation amortization component is very large. As I mentioned, you know, $3 billion asset, you expect a lot of depreciation, and hence you end up with a lower profit after tax, and then hence you will get that very high PE. So I think for utility type models like ourselves, almost utility like models like ourselves, you should be focused on, you know, EBITDA, perhaps even EBITDA multiples. I think some investors have looked at us that way instead of the PE ratio. I forget the second part of the question.
CAGR.
Oh, CAGR. Okay. Okay. First of all, I think you know, we have not given any guidance. I think in our outlook statement that we put out at the end of the year. We also knew that we were going to a disruptive period, if you may. And, you know, Yu Heng also mentioned about all the installation, diversion work that that did actually had to stop for a while. And I think, you know, we have a few things on our side. As Yu Heng mentioned, you know, 25,000 households, if indeed that number continues every year, translates to about maybe 1.5% increase in the total number of households. And it's very easy to then calculate taking, you know, $13.80, multiply by that and per month, multiply by the number of households to know how our revenue will grow. You know what our EBITDA margin has been that we have been able to achieve. So again, it's not difficult actually to demonstrate what potential CAGR in our EBITDA would be.
Gentlemen, given the focus on EBITDA, at what stage would you expect that you will need to set aside significant capex to replace either equipment, depreciation of equipment, and so forth?
The beauty of running a fiber network is that they last a long time. So the expectation is that fiber asset should last, you know, easily 25 or more years. That's just fiber. I'm talking about fiber. The ducts, the bulk of our asset is actually the ducts, the underground ducts, the manholes that you see on the road and all that. Those based on, I'm talking about accounting depreciation life first. The fiber is 25 years. Oh, sorry, the regulatory depreciation life. The fiber is 25 years and the ducts and manhole is 35 years. So this gives you a sense of what people expect this asset to last. But if you ask me, this fiber, once you put into the ground, they can last as long as the copper wires. You know, the copper wires have been put into the ground to serve us for a long, long time. They have served us for a long, long time, providing us telecom services. Fiber is basically a replacement of that. Fiber will also last us a long, long time. So unlike certain infrastructure assets, whereby at the end of an asset life, maybe 15 years or at most 20 years, you have to replace it completely. Fiber is not this kind of assets. We expect there's no one-time replacement of fiber asset required. So if certain fibers, let's say after a very long time, certain of the fiber need to be replaced, we will replace some of the fibers. But there is no such trigger as to replace the entire network that is required. In fact,
after the SMRT situation, you replace the whole network, you know.
You need to replace the, what you call that, the trains and so on. But we don't have this situation. We won't have this situation.
That's good to hear. Good reassurance. And you know, and then I think the next a lot of questions are coming in terms of what then would be the possibility of would you be able to increase dividends?
See, of course, equity has risks, right? All equities have risks, but they have different level of risk. So I would say to appreciate NetLink, we'll have to look at our business model, which is why we always have this slide on a resilient business model and trying to explain where our revenue is coming from. So if we look at this, the various stream of revenue, our revenue, a total of 73% is coming from connections today, right? These connection numbers, assuming our investors believe me that will not drop, then the connection revenue will continue to be there. It will not change. And then the rest, after taking out the 73%, the rest, a large part of it is contracted long-term with telcos. So telcos have to use our facility, they have to pay. So basically, in summary, we have a business model that is very stable. The revenue is going to be very stable. The issue for Lester and I and our management team is really thinking about how to grow it. We are less, we don't lose sleep too much about the downside risk because there are hardly any downside risks to our revenue. So with that, I would say, to answer your question, we expect the distribution to be stable. If we get the revenue that we expect, then we should continue to distribute. We also understand since our listing that a lot of the investors are attracted to NetLink because they would like the stable distribution. So as management, we have to do our best to make sure that we meet that expectation, because once we don't meet the expectation, people will be rather unhappy with us and they will sell the stock. So we understand the expectation, we understand our business model, and I think we will keep working this asset very hard to make sure that we continue the stable distribution. Obviously trying to think about what are the risks that might come. But as far as we can see, it's the risk to the level of growth. It's not the risk that will affect the baseline revenue that we have today. Yeah.
So I think one of the key questions is then connection fees, is that possible or being reduced? So that would be an impact to the revenue.
I would say yes. Increase or decrease, yes. You see, okay, I didn't want to go into the details of the regulatory model, but I will give a very simple example or description. There are more details in our slides. Actually, it's included in our slide pack, so anyone interested can have a look at it and can also look at our prospectus that describe it. But in short, the way we are regulated, the way the regulatory formula work for us is that they will reward us for the investment we make. So if we make a $100 investment, there is already a return agreed for 5 years. Based on the $100 investment, they will return us they will give us a fixed return on the $100 invested. So we are compensated in this way. So every 5 years, the regulator together with us will look at the total amount that we have invested, and they will also look at the rate of return. And using these two components, the total invested and the rate of return, they will work out what revenue I should get every year. So basically, that's the whole idea. So they will work out the revenue and say, okay, but they won't be working this out every year. They work it out once for the next 5 years. So once you work out for the next 5 years, you have a revenue for year 1, revenue for year 2, year 3, year 4, year 5. And the pricing is actually a derived number. So for example, the revenue for year 1 is $10. They say, okay, you should earn $10 because you only invested this amount, and based on the rate of return calculation, you should earn $10 for year 1. So, okay, $10. Let's see how many people are using your assets. 10 people are using, okay, so each one of them got to pay you $1. So the rate will be set at $1 per year for each person. So this pricing will change based on the number of people, number of users of the network. The more users we have, actually the lower the prices, provided we didn't make more investment. If we continue to make investment, then obviously the price will not come down so quickly. So a very good picture, looking ahead, a very good picture for us, I would say, and what we are always working towards is this: continue to be able to invest so that I get more revenue, but continue to increase the number of end users. Then it'll be a virtuous cycle. You invest more, you get more revenue, but at the same time, you have more users. So the cost is spread across more users in Singapore, and therefore each user will not have to bear such a high cost. We are like an essential utility. This formula is for essential utilities, right? We built the entire network to serve all the end users in Singapore. And internally, we run our model. We run many scenarios, different level of investment over the long run, not only 5 years, but for the next 15, 20 years, to work out what the cost would be to end users and all that. Of course, those are scenarios that we work out. And every now and then we have to come back and make some changes because the actual numbers may be higher or lower than what we have projected. But we are quite comfortable, to be honest, with the level of investment that we are making and the expected price that the consumer will be charged. Yeah.
Thank you very much. I think Lester and we've come to almost the end of the evening. I think for the viewers, I think what you can actually understand is that what NetLink is going to give you is striving to do is giving you stable returns. And I think we heard that quite a few times. They've explained in terms of the regulatory framework and how this is done to provide you that assurance of a stable return. With that, thank you very much, Yuheng, Lester. Thank you very much, Christine, and thank you very much, everyone, for listening in. I think we've just run out of time, and everybody just stay safe. I know we're all allowed to go out, but just wear your mask and please make sure you maintain a safe distance. With that, thank you, everybody. Have a good evening.
Thank you, Richard, and thank you, Christine, and thank you, everyone out there, for listening in. Thank you very much. Stay safe.
Mr. Wong. So we have come to the end of today's session. It has been a pleasure to have you with us this evening. Stay tuned for our next Corporate Connect webinar that will be held on 16 July. Thank you and have a great evening, everyone.
Thank you all.
Thank you.
Thank you.
Thank you all.
Bye-bye.
Bye.